Someone is shorting Bitcoin, and it might not be who you think. Guys, Tom Talks Crypto episode 5. I wanted to drop in with a quick update after an eventful end to last week. I wanted to let you know where we stand right now, where I see the biggest opportunities going into the coming week. And as a bonus at the end of the video, I've got a theory for you as to where some of the sell pressure in the crypto markets is coming from. Before we get to that, I want to preface this by saying nothing I say should be considered financial advice. This is just me musing about the markets for entertainment purposes only. But with that, let's jump into the charts and have a look at what happened last week. So as you're probably aware, if you're watching this, Bitcoin came up to hit major resistance at 72K, or key resistance at 72K, I should say, before being hammered back down to a low of $68,300. And since then, we've been kind of in this tight range at around the 69.3 area. A little bit earlier today, we came up to retest that descending trend line, this time at about $70,000 before being sold off fairly quickly after that. And now we're back in this 69.5 region. Not much to say about this from a technical perspective, except we're kind of holding at the local resistance turn support area. This is also well above that sort of mid mega range, if you like, at 67K. Really anywhere above that level, I think we still have a shot at new all-time highs from a technical perspective before a dip lower. Looking over at dollar cost index, you can see we came up on Friday to break back above this ascending trend line that we were formerly in before the breakdown. That move kind of precedes the move down in Bitcoin. As we know, the dollar cost index and risk assets like stocks, like Bitcoin, are generally speaking negatively correlated. That is to say, dollar cost index goes up, stocks and Bitcoin go down. And at least as of last Friday, it seems that correlation is alive and well. This move was likely influenced by expectations for FOMC, which we've got out this week. Overall, the rest of the market, including alts and lower caps, was hit much harder, generally speaking, than Bitcoin, for which at least the sentiment reigns pretty high. So what happened? Well, we knew there was a lot of sell-side liquidity up at key resistance at 72K. Limit orders stacked up in the book around that area. And to the downside, we got through some long liquidations. I thought Willy Woo put it really well. Bitcoin won't get nice things until the last minute degen longs give up chasing the price. If you want to go long, set your liquidations safely away from being squeezed by the whales. He is, of course, talking about retail sheep buying positions at the top of the market with money that they don't have, using too much leverage, and then getting liquidated. Talking of liquidations, if we look over at our CoinGlass liquidation map, we can see that the next key resistance at 72K, liquidations have crept up to somewhere in the region of $2.3 billion. At our next key resistance to the upside, which is the last resistance before all-time highs at 72.7, that number is above $4 billion worth of short positions that would be liquidated if we were to move beyond that level to the upside. More on those short positions a little bit later. But if we look to the downside, things don't really get terribly interesting until we get down to this kind of 66.5 level, looking at something like $3.5 billion worth of long positions that would be liquidated. And then down at 65, things are really interesting at $7 billion worth of long positions that would be liquidated to the downside. So in terms of fundamentals, everything remains pretty positive. Really big week for the ETFs. Closed the week with a $131 million inflow day on the 7th of June. That also marked 19 consecutive days of inflows, which is of course the longest run that they've had since approval. Fun fact on the Bitcoin spot ETFs, as if you haven't heard enough fun facts on spot Bitcoin ETFs already, it took gold ETFs 5 years to cross the $15 billion worth of inflows mark after they were approved. It took Bitcoin 5 months. Obviously, there's been a lot of inflation since gold ETFs were approved, but that's still staggering. And it just points towards really bullish institutional sentiment towards Bitcoin. Bitcoin is here and it is here to stay. Also a big week for whales of all kinds. As you can see here, Bitcoin whales have opened gigalong positions on Bybit and OKX, tweeted by Ash. Last time this happened when Bitcoin was at 29K, which resulted in a 155% pump. You see this trend reflected in the on-chain data. So this is a chart by Glassnode. Supply held by entities with balance 100 to 1K BTC, i.e. whales. This took a massive hike just after the ETFs were approved back in January. But as you can see, still trending up now, even though we are technically in a downtrend for Bitcoin. And from a retail perspective, we mentioned last week, crypto and Bitcoin are down in terms of Google trends and in terms of YouTube trends. That essentially means there is a massive amount of capital, retail capital out there still waiting to come into the market, and the market is gearing up for that. So a couple of stories from last week. You'll remember Binance resumed MasterCard payments for crypto. That's massive. That was lost back in August 2023. Really, really inconvenient. Bybit started opening up trading again to Chinese users living overseas. Of course, there's been an official ban in mainland China for crypto mining and crypto investing since 2021. And Robinhood, one of the biggest trading apps in the US, acquired Bitstamp for $200 million. The deal isn't finalized yet, but of course, Bitstamp is one of the oldest crypto exchanges. It was the first crypto exchange to achieve FCA regulation in the UK. And Robinhood is a massive, massive trading app for US retail users. So this is expanding their crypto reach and again opening up big section of the retail market that apparently hasn't entered the space yet this cycle. So fundamentals are strong, sentiment is strong, technicals are pretty strong. Why isn't price going up? Well, somebody is selling, evidently. Supply and demand. But who's selling? It might not be who you expect. But let's take a look at that. So guys, ultimately I think you can put sellers in the market into two categories. Number one, you've got people who are selling because they have to sell or because they're forced to sell. These are our retail traders or high leverage traders getting forced out of their positions, i.e. becoming liquidated because they don't have enough capital or enough margin to sustain that position any longer. Those are people who aren't choosing to sell, but they are being forced to sell because they simply don't have enough money to hold that position. They didn't have enough money to get into that position in the first place, but that's a whole other story. The second category is traders who are choosing to sell. So within this, we've got people who are taking profits, i.e. they're exiting trades profitably at a higher price than they bought them. And you've also got the short sellers. At $72,000, over $2 billion worth of short positions would be liquidated to the upside. That means there are short positions in the market, right? But who is shorting? So this chart is showing you Bitcoin leverage funds net total combined. And essentially what we're seeing here is it is a new record short position. So as Vivek puts it, hedge funds are shorting Bitcoin like never before. It's time. Let's liquidate them all. Retweet to spread the word. Send it. So I think if we dive into this a little bit deeper, it's not quite a GameStop situation, okay? So hedge funds hold record bearish Bitcoin bets. That's true enough. But if we look into this a bit deeper, it's speculated most funds may have taken short positions as part of a carry trade. So let me break this down for you. CME is the largest regulated Bitcoin futures venue. Generally speaking, futures contracts with a longer expiry trade at a premium to the underlying spot Bitcoin price. So an arbitrage opportunity exists for investors whereby they can enter a carry trade, buying the underlying spot Bitcoin, going long, and simultaneously shorting the same amount of the futures contract. When the price of the futures contract and the underlying Bitcoin spot price converge closer to expiry, the trader can exit the position, selling the long and simultaneously covering the short, and effectively pocketing the difference that existed or the contango that existed when they took the trade. This is an example of a delta neutral trading strategy, i.e. it is not affected by fluctuations in the market. The position is hedged. Hedged position, hedged fund. You get the picture. So where things get really interesting is actually on the buy side of that position. As you'll understand, that involves institutions, hedge funds, buying large amounts of spot Bitcoin. And there is speculation that a lot of the ETF inflows that we've seen are actually part of that carry trade, i.e. the hedge funds going long via the ETFs to balance the short positions on the futures contracts and make a complete carry trade. So a tweet here from CMS, I love a good conspiracy to blow up Bitcoin shorts, but this ain't it. It's entities buying ETF and selling futures to roll down basis. Some primes are letting entities net that. A similar conclusion can be drawn from the fact that open interest, or the dollar value dedicated to active CME Bitcoin futures contracts sized at 5 BTC, has grown in tandem with the cumulative ETF inflows. In other words, record shorts aren't necessarily outright bearish bets. ETF inflows don't necessarily represent outright bullish bets, just two components of a carry trade. So possibly not a massive GameStop style short squeeze coming, given that something like this would point to essentially equal parts supply and demand. I think, as with all things, it's important to take this with a pinch of salt and in context of the broader market, right? I mean, just for one, the on-chain data we looked at earlier still points to long-term accumulation by whales. Hedge funds do tend to know what they're doing, even if they do get shown up from time to time, a la GameStop. As I mentioned, this is a delta neutral strategy, but the short portion of that carry trade can absolutely still become liquidated. Guys, in any case, thank you so much for listening. I hope you found some of that interesting, if not at the very least entertaining. Plenty more to come. Catch you in the next one. Cheers. Bye-bye.